That's great. So the first item on the agenda is House Bill 4116, sponsored by Representative Kahle. You can come up, Representative Kahle. Are you doing it together? Okay, then whoever's coming can come up. So this is an interesting concept that we're going to explore today, and basically, the idea is sort of more of a private sector solution to how we invest in our Michigan businesses. And I know we've had a little bit of conversation about it, and there's some very interesting information that you've learned about other states and provinces and other countries that have done this. So we're interested in hearing your testimony today, you know, in part as part of this larger conversation about what do we do as a state to keep our businesses and also to attract new businesses to our state. But much of that conversation is about how do we attract new businesses to our state. And we can't forget about our local businesses that are here already that are looking to expand. And so I know, Rep. Kahle, you've come up with this bill, which is a creative way through the private sector of encouraging investment from Michigan residents into Michigan businesses to help them stay here and grow. So we're interested to hear the testimony today, and your guest also, hopefully he can introduce himself as well. And we look forward to hearing your testimony today, Representative.
All right, well, thank you very much, Chairman Hall and members of the Tax Policy Committee. I really appreciate the opportunity to share testimony with you on House Bill 4116, a plan that is designed to encourage Michigan residents to make direct financial investments in new or existing Michigan businesses. I do have with me a guest from R-Adrian, Chris Miller. And Chris Miller is not new to testifying in front of tax policy. He's done this many times before, and he'll share a little bit of background, as will I, on some legislation that came about in Michigan and helped us lead the country that he was very much a part of related to crowdfunding, which you might now be familiar with. Well, this man here we have to thank for helping to bring that to Michigan and making us a leader in that space in roughly 2012 or 13. So just some background, though. I began looking at this and working with Chris in February of 2020. In fact, I got a research request back from the Legislative Services Bureau on this type of small business tax credits historically in Michigan and around the country and at the federal level at the end of February of 2020. So needless to say, I put this whole thing on the shelf because a couple of weeks later, we all know what happened. And but now, as we've seen the impact, particularly on our small communities and our small businesses from the government's response to COVID, this is more timely than ever because this is local community focused above all. So as these small businesses all around us in your districts, around our state, are emerging from the challenges of COVID-19 and startup businesses are looking for financial assistance, it has been argued that a tax credit for investing in businesses would help spur healthy economic growth in our state. An income tax credit for investments made in Michigan businesses could help new businesses become established and allow existing businesses to continue operating or to expand their operation. So this bill provides a first-in-the-nation state income tax credit equal to 50% of an investment made by a Michigan resident in a Michigan business. This new type of investment opportunity has even been made possible in the first place by the adoption of recent state and federal legislation that empowers all community members to become investors in their own communities. I made reference to that, MILE, it's called, or the crowdfunding. So I'm going to give you a super quick bit of history. From 1933, and I mean going back, and I'll be brief, until the passage of the Jobs Act in 2012, it was nearly impossible for most regular, everyday citizens to make legal direct investments in businesses. Shortly after the establishment of the Federal Securities and Exchange Commission, the SEC as we call it, during the Great Depression, the SEC divided the investment world into two categories. Can be an accredited investor, or you're a non-accredited investor. And so I think we all know accredited investors, that is the very wealthy, that is not representative of most of the population and not representative of most of the people here in Michigan. I think there's only roughly 7% of Michigan residents that would be considered accredited investors, thereabouts. So we have that division. So what about the other 93% of us? Today, regulation crowdfunding on a federal level and state-based legislation like our own MILE Act, MILE, that stands for Michigan Invest Locally Exemption, that exists. And it provides opportunities today for all investors to make financial investments into local businesses in their community. There may be some examples in your district. There's certainly some in mine where this has been successful. So that legislative change has been aided by technology where management of deals that included large numbers of investors has been automated, it's been supported by hardware and software, and it makes it possible to manage capital raises and meet the reporting requirements in a cost-effective manner. So at present, just a little bit of trivia because it ties into what's before you now. More than 50 websites are in place across the country that facilitate and manage these kinds of capital raises. I will just say that this kind of investing, and again, think about COVID, think about the impact to the mom and pops, the small restaurants, the local businesses in your downtown. This kind of investing is uniquely and powerfully beneficial to local communities, to residents, and to local and state governments, to the tax base, and to startups, and to existing businesses alike. In a time when, as I said, it's been tough for our small businesses, local capital sourced from members of the community can be a real game changer and a win-win for everyone when we're looking at economic development going forward. This bill, House Bill 4116, provides an opportunity to accelerate the local investing movement, further encouraging Michigan citizens to invest in Michigan businesses. As I said, it provides a state of Michigan income tax credit valued at 50% of the amount of money any Michigan resident, got to be a Michigan resident, invest in a Michigan business, has to be a Michigan business. It also provides a carry forward feature that gives investors 10 years to carry the state income tax credit forward if an investor doesn't have a state income tax liability that would equal that amount. In summary, the local capital movement continues to grow. Michigan is one of the leading states in the use of local capital, or has been, and the plan before you today will continue to make our state a leader in the investment crowdfunding space, offering opportunities for healthy economic growth. So we can and should take this opportunity to lead the country by encouraging our citizens, everyday citizens, to help build stronger and healthy economies through this legislation. And if it's okay with you, Mr. Chair, if may I introduce Chris Miller, who's been involved in economic development for many years. As I said, he spearheaded the MILE legislation, the crowdfunding legislation, almost 10 years ago now, and travels the country speaking to this. And if he could share a little, and then the two of us take questions.
Sure, we'll do that. And Chris, I know you're with PlaneWave Instruments now. You're a special projects consultant there, but it's also my understanding you led economic development in Lenawee County and R-Adrian before that. Is that right?
That's correct. So I served as the economic developer for the city of R-Adrian for 11 years. Prior to that, was a city commissioner, DDA board member. So for about the past 15 years or so, I've been working pretty directly in economic development in my community. And because of the work around MILE a decade ago, really across the state initially and now across the country. So in addition to working at PlaneWave, and I invite all of you to come to R-Adrian and see PlaneWave. It's a pretty cool story. This was part of the economic development work that I did when I was with the city. This was a, a retention/attraction project where we brought a firm from Southern California, lock, stock, and barrel, all the equipment to Adrian, where they now operate their world headquarters. In addition to that, this year I'm serving as a fellow at the Michigan State University Center for Regional Economic Innovation, and that work is to really accelerate this local capital movement. And I wanted to make sure to give credit to those guys as well as the folks at PlaneWave, who are very supportive of this work and, in fact, are engaged in some significant community investments themselves. So the kind of background to Mile and how I entered into this was I became an economic developer at the end of the Great Recession, a really lousy time to become an economic developer because it was really tough to get capital. And I was particularly interested in the entrepreneur side of the scale, not so much the business attraction side, because that looked like a zero-sum game to me. And in fact, it is. And research has more recently shown that a lot of those attraction projects where a tremendous amount of incentives are given to the companies and they come into the community, that the promises made or the commitments made are rarely met. And so the attraction game is pretty challenging, and there's always a loser in that. And in fact, many communities end up losing it. So I was really a lot more interested in what was then called economic gardening, that is the development of local businesses and the encouragement of new local businesses, and looking for ways to find capital to make those businesses be established and grow in our communities. And it was challenging. At the time of the recession, you may remember that even existing businesses that had long-term relationships with banks had a tough time getting capital. And so turning to the community for that, which the investment crowdfunding world did. I think you're probably all familiar with at least Kickstarter, which is a donation crowdfunding campaign, and there are rewards crowdfunding campaigns. But the key piece has been investment campaigns, a way for us to actually make a financial investment into businesses in our own community and our own state and get a financial return on those. And so that's the work that I've been at for the last decade. I'm also part of a national group called the National Coalition for Community Capital. We're a nonprofit 501c3 also promoting the idea of local capital. And so one of the things that we've seen, one of the challenges is how do we get people to do new things? Because most of us never had the experience of investing directly in a small business in our communities. Our parents didn't, our grandparents didn't most often. And so it's new. There's also no infrastructure around it. When we first rolled out Mile, I remember having dozens of conversations with investment advisors and attorneys, all of whom had no idea about it, but said, oh, securities laws, you've got to stay as far away from that as you possibly can. So it's challenging, and it has been challenging. While we've seen really dramatic rises in particular, the investment crowdfunding world in 2020 and 2021, we just passed $1 billion in total investments since essentially 2014 when this became legal to do in the United States. Michigan, as we noted, was an early winner in that. We were the fourth state to have an exemption, an intrastate exemption, and today 36 states have an exemption to allow that kind of investing to take place. But we've recognized that we still need to find ways to incentivize people to invest in their communities. And that is really at the genesis of this bill before you today. How do we get people to do this that also allows a terrific benefit for the community? And so one of the really exciting things, and you have a sheet in front of you today that says the Nova Scotia Economic Development Investment Fund. So as we're doing these deals, and we started in 2013, was the first investment crowdfunding deal that I worked on in Michigan, and I've worked on a number of them since. So I've seen great examples of individual success.
Real quick,
Yeah.
and I think you gave each member of the committee a copy of this document, which says the Nova Scotia Economic Development Investment Fund, so we can follow along. And this will also be in the minutes. So after the meeting, if you know, people can look at these documents you're referencing as well on our website. So go ahead.
Great, thank you. We've seen anecdotally the success of these raises where small businesses have been started. I've worked on a number of them themselves. The first one in Michigan was the Tecumseh Brewing Company, where they were working to try and get a traditional bank loan They had pretty great credentials. They had a guy who came from California, went to business school at the University of Michigan, the Ross School for Business there, got his degree. His partner was a award-winning brewmaster. They were working at the Blue Moon bar in Ann Arbor and decided they wanted to open up a place in Tecumseh. And they went to friends and family, borrowed enough money to buy a building in downtown Tecumseh, so that was paid off. They had that as collateral. They could not get any financing through traditional terms. That was 2012, 2013. And so we worked with them because Mile had just been passed, and they raised $175,000 from 23 investors in the community, then went back to the bank and got an additional $150,000. And have paid all of those investors off, have since borrowed again to buy a second building, and last year when COVID hit, they went and borrowed another $90,000 and bought a food truck. So I've seen firsthand how successful that can be. My wife actually and her partners recently opened up a business in downtown Adrian. They raised $120,000 from 43 investors from 7 different states to help open that business in downtown Adrian. So I've experienced it firsthand in my own family as well as across the country. But what's exciting about the Nova Scotia example is that there we have a similar program which has been in place since 1999. And so in Nova Scotia, they decided to set up essentially a fund. So this would be a pooled investment vehicle. By and large, the investment crowdfunding projects are individual businesses raising funds. We're definitely big fans at the National Coalition for Community Capital of pooled investment vehicles as well. We actually have a proposal in front of the Securities and Exchange Commission right now for what we've called a 21st Century Community Investment Fund that would be possible for every Michigan community to have a fund like this. Nothing like that exists right now. But in the meantime, in Nova Scotia, they did it 20 years ago, and they finally got some great research done, which just started in 2019, finished up in 2020, and this research was published in spring of this year, so we got our hands on it. And it shows some pretty exciting things, we think. For me, from a government perspective, what's most notable is how efficient this fund was at generating new employment. And if you look at the bullet points at the bottom of that, you'll see that this fund works by engaging people, encouraging people to put their money in by providing a tax credit. And once that money is in there, it's then in turn invested in small businesses, startups, and existing businesses in Nova Scotia. And in 2019, they received $2 million worth of investment. There was a $700,000, so a 35% tax credit that went to those investors that put the $2 million. And a really exciting response to that, or result of that, 1,200 full-time jobs were created. And if you do that math, that means the cost per job that the province incentivized those projects with was $583. Now, I've worked at a ton of projects where we have looked to incentivize businesses, including PlaneWave, in the city of Adrian. And I can tell you that most of the time, the incentive provided by the units of government is in the tens of thousands of dollars, sometimes over $100,000 to bring a single job into a community. So the idea that we could do that for $583 in a program that's been around for 20 years is, I think, really exciting and a great use of government resources.
All right, thank you, Chris. And I'll just read these cards in, and then we'll take some questions. So we have a card here from the Michigan Municipal League that they support the bill. We also have a card from the Michigan Chamber that they support the bill. I was wondering maybe before we go to Rep. Beeler, if you could talk a little bit about the collaboration with the Michigan Municipal League, and I noticed they've supported this bill, so maybe you can talk a little bit about that outreach that you've done on this legislation.
For sure, thank you. So MML actually was really engaged in the mile legislation. So as we worked on that with Bronna's predecessor in Adrian, who introduced that legislation, I had been very active in MML as an elected official and remain a big fan of the work that they've done. So as we worked on this legislation, I kept them informed of that. I was actually sitting on MML's Economic Development Committee as a committee member, and so we talked about this legislation as it came through. And in the same way, they were supportive of this idea of mile and what that could mean for local communities and local businesses and downtown main streets, et cetera, bringing and retaining and recirculating capital on a local level. They recognize the ability of this legislation to do the same thing. And I think, interestingly, I know many of you are engaged in MML or follow MML, but you may recall that for the past decade, MML has been literally one of the nation-leading organizations of its type to support placemaking. And they've done a phenomenally good job of that, and there are dozens of Michigan communities that have done exceptionally well using placemaking. What they came to realize was that you can't do great placemaking if you don't have capital to do so. And so this year, they transitioned their focus to building wealth in local communities. So wealth building is their focus now going forward, which, again, I think is genius and nation-leading, because we need local individuals to be wealthy, we need local communities to be wealthy and to have capital. And we think this is a great way to do that. So this is why MML is as supportive. I'm thrilled to hear the Chamber, Michigan Chamber has also come on board. We've also reached out to them primarily through local chambers as well. As part of my fellowship, I did a lot of outreach to communities, educating them about the possibility of this, and a number of them recognize that. Actually, the city of Charlevoix, DDA, was the first local unit that came on board officially and endorsed this probably 6 months ago.
Can you speak a little bit to the protections in this bill about, because, you're talking a lot about small businesses on Main Street and communities like Adrian and Marshall and places like that. Can you talk a little bit about the protections in this bill that prevent this investment from going to a person's own family business, or maybe they're investing in some major tech company or something that's in some other state? Can you talk about the protections in this bill that would prevent that? Sure.
So to begin with, this bill would only apply to Michigan businesses. So Michigan businesses, as the IRS defines them, except there's what's called an 80% rule, so 80% of the staff, the business, that kind of thing. So it is really focused on the idea that we retain this capital in the community. The other protections really come from the fact that all investment is still under the oversight of the Securities and Exchange Commission on a federal level. So the reality is that for most of us, the non-accredited investors in the room and in the country and in the state, you are limited rather dramatically in how much money you can invest on an annual basis in these kinds of projects. And essentially, in virtually every case, there will be no non-accredited investor who can invest more than about $5,000 on an annual basis in a project like this under federal regulations. Michigan's mile is more generous. That allows a $10,000 investment. But essentially, those protections remain in place. In these deals, how they work is the local business actually determines what they're going to offer in return for an investment. And that may be a debt position, that is that you loan money to them. It may be an ownership money or an equity position where they give you part of the ownership, or it could be a blend of those two kinds of things. Those are all governed by federal oversight as well. So those offers officially are overseen on a federal level and also on a state level to ensure that all of the protections that any investor would have for any investment are in place for those folks as well.
Okay, and when I look at the definition here of qualified investment, I notice it specifically prohibits that investment if it's a member of the investor's family or things like that as well. So this would not be a way for somebody to enrich their own family through a tax credit.
Correct. And let me say a word about fraud. That was one of the big issues that we faced when this first rolled out a decade ago. And it was what everyone was really worried about. So the World Bank actually did some research on fraud in community capital investments like these in about 2015. And they looked at all the countries where this takes place. Actually, Great Britain has done quite a lot of work in this space. Australia has, some other countries as well. And they found less than 2% in every instance of fraud occurred in any of those. In the U.S., for the first time about a month ago, there was the SEC brought charges against someone who raised money in an investment crowdfunding raise, and the SEC clamped on that and accused them of fraud. So in the $1 billion that's been done so far, there has been literally one deal in the U.S. where there was fraud involved. It was a marijuana deal, multi-state, so it was not a local deal like we're talking about here, but that is it. So we've really seen very little of that, especially as compared to the kind of fraud we've seen in other kinds of investments.
All right, we'll go to Representative Beeler.
Thank you, Mr. Chair, and thank you, sir, for your testimony. Could you speak briefly to the process that you go through as a private investor when it comes to making the decision on which businesses you'll invest in and which ones you won't, particularly with the risk that you are incurring as the investor and how that translates into your vested interest in the success of that business?
Sure. So, as you know, there are parameters that when you talk to an investment advisor, they're going to talk to you about how much you're going to put in. Can you afford to lose it all? That's the number one issue. And so, we do all that. When these deals are presented on the platforms, there is a business plan, there are financial projections, there is a biography of the major players. So there is the same due diligence that's required for any investment. That information is made available. Typically, those investors avail themselves of that information as they look over it. One of the things that I'll say, however, that's unique about this, I suspect that in your communities, you can go up and down the blocks of them and you can say, this is a great business, this is not a great business, even if you don't look at the financials, because the fruits of that work is evident. And I think that local piece is also, you have to factor that in. Because we do know our own communities and we know those businesses. We may be friends and neighbors. Our kids may work for them, that kind of thing. So I think that piece also enters in it. But we absolutely, one of my colleagues, Angela Barbesh, she was also one of the founding board members of the National Coalition for Community Capital. She's an investment advisor in Ypsilanti. She's one of the nation's leading investment advisors on this local investing piece. And she worked with the Michigan Economic Development Corporation a couple of years ago. They did an investor training program all over the state. And she now has those materials available. We do nationally have them available as well. We're very interested in folks educating themselves and making good investment decisions. But all of the data is there and is available for them to make those decisions.
Thank you. So it's fair to say that you do more than your due diligence, with your primary concern being finding a successful business that would be successful provided enough capital to get it off the ground.
That's correct.
Thank you.
Mm-hmm.
Representative Johnson.
Thank you, Mr. Chair. I've got a few questions, if I may.
Yeah, go ahead.
So the Nova Scotia Economic Development Investment Fund, that's a fund that people put money into. What we're doing here, there's no fund. We put the money directly into the business, right?
So the tax credit would go to the investor in this case. The investor would have to invest in a Michigan business. That could be a direct investment. It also potentially could be through a fund.
Okay. But the Nova Scotia thing, they weren't going directly to a business. It sounded like that was more to a fund that then doled out the money. I want to make sure that's not what we're doing here. Here, I could go directly to the company.
Again, it's not necessarily directly through the company. What the credit goes to the investor, and in the case of Nova Scotia, the credit goes to the investor as well. So we would be incentivizing the investor. The investor could invest through a fund in a Michigan business or could make a direct investment in a Michigan business. They don't do, in the Nova Scotia model, they do not do direct investments from the creditor, from the investor directly to the business.
Okay. Because that's how I think I would view this, is you'd have a business and say, hey, I want to invest in this. The way I'm reading this, if there's a Michigan business that meets this requirements of 80% of its operations in the state, 80% of its assets in the state, if they're on, let's say they're on the stock exchange market, could I just be buying their stock through my Robinhood app, and that would then be, I could get a tax credit for that?
So I don't know the answer to that question, but these businesses would not be going, they wouldn't be public businesses. They would still be private businesses this would be a private offering. So I think
Where does that, I don't see that in the bill. I guess where,
And I know, just real quick here, the Michigan Strategic Fund certifies which companies can make these investments and which can't. Is that correct?
they would, yeah, go ahead.
Yeah, that is correct. They would be the overseeing body to do the certification when it meets the criteria that is actually listed in the bill. And Rep. Johnson, if you would like to see that tightened up, if that would help bring you to a position of support, I'd be, very interested in having the conversation. Thank you for raising it.
I think being public's good. I don't think we should limit if you're going to do this. I have concerns. But I guess I'm just trying to walk myself through the practicality here. So if it were a public company, because that's very easy with our Robinhood app. So let's say I put money into it. I now get that tax credit. Could I then just take that money directly back out? Like with Robinhood, I can buy and sell same day. Where do I end up having to pay taxes? 'Cause let's say I invest $1,000 into Michigan company ABC. I now don't have to pay my income tax on that $1,000. I then sell immediately my investment within that company. I don't have to pay any capital gains because assuming the price hasn't really changed, did I just basically shortchange my income tax by $1,000 without really doing a true investment? I mean, how long do I have to actually hold the investment in the company? Because if I can just buy it and sell it immediately, it looks like I'm just getting around the income tax, which I'm a big fan of. I hate the income tax, but my guess is that's not your intent here. And it seems like that would allow that to happen.
So it's interesting because I can't give the clear answer to that now. However, we can look to what other states have done and some of the other federal programs that exist today related to incentivizing investors by giving them a tax credit. You've got angel investor credits. I would recommend checking out the Angel Capital Association. Iowa has an Iowa Angel Investor Tax Credit. Wisconsin has an early stage business investment program. There's Ohio has the Ohio New Markets Tax Credit. Illinois has the Illinois New Markets Development Program. Now, those are the idea of they would address, I think, and I'd be happy to work with you on this research or just get it to you straight up to tighten up, answer the question you're raising. But I think we can look and see how they apply your very question. This, though, I do want to emphasize again that the intent of this legislation is to focus on Michigan businesses within the local community that do meet the definition of, as defined, of the, where is it in here? The qualified business, which does mean a business that the Michigan Strategic Fund certifies as in compliance with all of the following at the time of the investment. So certainly this conversation can continue, but for your question, I think there is information out there that's available. Glad to do that research and get you the answer you're looking for.
Okay, thank you. And one last comment is that I'm looking, a lot of this seems to be limiting to stuff occurring within the state. If we want these businesses to grow, then they're going to have clients nationwide, internationally, hopefully. So I'm not sure we want to limit where their transactions are occurring, maybe where their assets and they're headquartered in Michigan, but I don't think we want to limit their customer base to Michigan. Just another comment. Thank you, Mr. Chair.
All right. Next, we'll go to Representative Yancey.
Thank you, Mr. Chair, and thank you for your testimony. So mine is going to go back to the opportunities for fraud. What would prevent, and I'll use me as an example reluctantly. Let's say that my best friend, who's a business owner, has the investment that she needs for her business, but she knows about this tax credit. What prevents her, I'm not family, from giving me her money to invest, and then I get the 50% back to give back to her, the kickback?
Not sure in that scenario exactly how that would potentially take place.
But I can see how some savvy business owners could possibly take advantage of this tax credit in that way, as opposed to it encouraging others from investing. It'll maybe encourage some from, and it's not that easy of a way to prove fraud. So what would we do to protect that or keep that from happening?
Be glad to continue to look into that. That's why I was looking forward to the conversation today. If you go back to, when the mile legislation was brought forward, that has now been around for a while, the crowdfunding, there was many, many questions, and that helped create the positive outcome at the end. So that's a great point.
I have one follow-up, Mr. Chair, if I may. And then in the bill, you prevent the investor's family from being involved with the business, but is there anything that spells out that the investor himself cannot be a partner or have any investment or any business interests?
Well, that the investor himself couldn't have, be an owner in the business? So, no, under
Just line 11.
the investor could have an ownership position in the business. It depends on what the offer looks like. So I would tell you nationally, in these community-funded projects, about half of them, the investors do have an ownership in the position, an ownership position in the business, and in the other, they're simply a debt position. They're loaning money to the business. So.
Okay. Thank you.
All right, we'll go now to Representative Tisdale.
Thank you, Chair Hall. And again, I'm focused on operationally here, which I guess is a good sign. We're trying to think how this would be implemented.
Yeah.
And so my guess is, and you talked about there were 20 investors, 20 small investors in one project, 40 in another. So there's a third-party aggregator out there someplace that's SEC licensed.
Yes, correct. Thank you. The federal legislation and most state legislation on this front requires a certified portal, so a platform that has its own website that manages that on behalf of the businesses. So the vast majority of those deals that have happened over the past 4 or 5 years have used a portal, and that portal does the reporting requirement, produces the documents for the reporting requirements for both the business and the investors. It's part of the reason that this works, is that the portals have written the software so they can manage those investors, so for example, my wife's business, every quarter they have to generate 47 checks out, or 43 checks out to send to the investors, because they're on what's called a revenue share. So they're getting a percentage of the gross revenues, goes back to the investor proportionally. But yes, those are all managed by platforms that provide the due diligence documentation and compliance issues.
Through an SEC licensed
Correct.
platform, so there's uniformity.
Yes.
There's consistency in contracts, expectations, legal obligations, all
Exactly.
those kinds of things. And I think to Vice Chair Yancey's question, I think what you were indicating is that these can be debt positions or equity positions.
That's correct.
When she was talking about an investor being an owner, that would be after they're an investor. Then that's how they acquire the ownership
That's
or equity
correct.
position, not an owner to begin with.
Right.
So, okay, that makes it a lot more comfortable in my mind. Thank you.
Thank you.
Representative Koopa.
Thank you, Chair Hall, and thank you, Representative Kahle. And I just have a question, kind of two-part. One is, how will this help areas of our state that don't necessarily have equal financial wealth? And how will it prevent outsiders from coming in and changing the fabric of our communities?
Oh, great question. So one of the things that we've seen, and again, we're just beginning to do research on these kinds of community investments that we're seeing. But one of the things that we're seeing happening as a matter of course in those is that the founders, the businesses that are being supported, look a lot more like their communities than traditional financing. So for example, last year nationally, 7% of venture capital money went to women-owned businesses. I don't know if you're aware of this or not, ladies, but you are 51% of the population. And the fact is, traditional capital sources have not served women or minorities, communities of color well at all. On the other hand, when the community is making that investment, they look a lot more like that. So I think there is sort of an inherent protection there. And again, we're talking a lot about startup businesses, small businesses, community-based businesses. And so in my wife's case, we had investors from 7 different states. That wasn't because we had family in 7 different states. It's because they went on the platform and looked and loved the idea of the project. And the reality is it got broad support from the community. The overwhelming number of investors were from the community. Few came from outside the community. The returns on the investment is another piece. So, typically if people are looking for big returns, they're looking to tech. They're looking at industries that are going to scale up rapidly and be bought out by somebody so they get a quick exit and make a lot of money. This is more like slow money investments, that you're putting them in there and you're leaving them for a while. So typically the typical term right now for these deals is 5 years. So as an investor, you loan money to them for 5 years, or you pay them and you become part of the ownership, and it takes 5 years for you to be paid back for that ownership position, or that ownership investment. So I think the model itself really addresses that in a significant way. And again, the fact that it's Michigan businesses, again, that are primarily in Michigan, and it's only for Michigan investors. So we're not going to see big money from the West Coast or the East Coast or China or something coming in. It's only Michigan investors that qualify for this.
But what happens if, I guess it's still not clear to me, what happens if somebody who is affluent, say from Troy, goes to another community and invests in that community in a business? Like there's an imbalance there.
So sure. So if somebody from Troy invested in a project in Detroit, their part of the capital is going to leave Detroit and go to Troy, and so that's certainly the case. But for my money, it's a lot better than it leaves the state or it leaves the country, which is largely what we're seeing today. So this is not a perfect solution. It's a way to incentivize a good solution and an effective use, I think, of government and incentives. So,
thank you.
Mm-hmm.
All right, thank you. We have no more questions for you, so we appreciate your testimony and creative idea you've come up with to be part of the solution for Michigan as we look at how to attract and retain jobs in our state. So thank you.
Great. Well, and thank you for the good questions, especially a couple of tough ones. We'll do a little bit of work and see what we can do to respond.
All right.
Thank you.
We'll go back now to bring up the Treasury, our friends, Aaron Kahle and Scott Dara, which I don't know, has Scott been in front of the committee this year? No? Well, welcome. Welcome to the committee. A long anticipated debut. So we had another colleague of yours come up last week and make her debut. So we're happy to have you here, Scott. And so everyone knows what we're talking about. We're back to House Bill 4116, which we just heard quite a bit of testimony about. So this says that you wish to speak, Aaron, and that you oppose the bill. So we look forward to hearing testimony from you and Scott here today. Welcome.
Thank you, Mr. Chairman, members of the committee. Great to be back here. Aaron Kahle, Director of Legislative Affairs for the Department of Treasury, and with me is Scott Dara, Administrator of the Tax Analysis Division within Treasury's Office of Revenue and Tax Analysis. Treasury is opposed to House Bill 4116, and there are a couple areas of concern that I wanted to focus my testimony on today. First, the 50% credit in the legislation is higher than what is provided in most other states who have a similar program. Other states also include maximum credit amounts for individual taxpayers, overall annual maximum on the credit, or both. And because the credit is not limited or capped in any way, the amount of available credits could vary from year to year. Couple this with being able to carry the credit forward for up to 10 years, and this legislation has the potential to blow a hole in future state budgets. However, I will note that from our perspective at this time, the revenue impact cannot be determined precisely because it will be determined by the effective date, which is unclear in the bill, timing of the investment, and the volume of qualified investments in qualified businesses. Our best estimate is that the annual cost could be around $25 million per year, but that's based on the total new venture capital raised from angel investors in 2020. But the key point that I want to leave you with as it relates to this cost estimate is that the cost is unknown, and the bill establishes no cost limits. So that's the key point on the estimate. Also, from a policy perspective, and unlike prior angel investor programs that we've seen, House Bill 4116 is far less restrictive as to the type of businesses in which the investment can be made. The investment does not need to be in a business within a particular industry or in a particular stage of development or of a particular size. So we're not incentivizing anything really in particular here. In fact, it is difficult to predict whether the income tax credit will have the intended effect of increasing any angel investment in Michigan businesses. And recent studies confirm that while it may increase angel investing, that investment has no significant impact on entrepreneurial activity more generally. Finally, I'll just end on a more general comment. If the state is going to fund angel investors and venture capital, we believe that it should be more targeted. Also, as some of the questions got to, and I'm not as familiar with the Nova Scotia example, I just heard about it from the prior testimony, but we do believe that it should be through a fund, and a fund that we could get equity from. We should not be doing this as a tax credit. And with that, I'd be happy to answer any questions.
All right, thank you. Now, I heard in the previous testimony that there was a federal cap, and then it kind of referred, and I think the person who testified before, Chris, said there was a $5,000 cap, but then he mentioned there was a $10,000 cap in the Michigan law that we put in place. And do you have any familiarity with those caps, either one of you? Or is that something maybe we need to look more into?
Yeah, we'd have to look more into that, Mr. Chair.
Okay. Yeah, that's the thing. These bills, they reference other sections of law. You got to go look at those other things and analyze them because it sounds like there might be some caps in place here, but we'll look into it too. Did you, and I heard in the, the Nova Scotia example, which, like I mentioned, will be in our minutes, and we're happy to give you info on, and we look forward to a dialogue just looking into this Nova Scotia example, because I'll tell you, Aaron, I mean, according to the example, it sounds like the cost to government per job was $583. That's pretty good, isn't it?
Sounds pretty good.
It's pretty
I'm
good.
not as familiar
So
with that example.
we'll have to
though. I
look
can't
into
speak
it.
to
It's impressive. We'll
Yeah.
go to Representative Beeler.
Thank you, Mr. Chair. So you touched on some of the costs of what the tax credit would do, which I think is totally fair from your perspective to see what it's going to cost the state. But would you be willing to acknowledge that there's a potential of increased tax revenue from a new successful business that was able to be started because an investor was able to give them the capital to get off the ground? Is there any acknowledgement that this could increase the tax base, grow the size of the pie?
Mr. Darren, can you take that?
Absolutely, because that's the nature of venture capital investment, is that while there's significant risk, there is the potential for significant reward.
Right. And so, I mean, these guys are pretty good at investing, otherwise they wouldn't still be investors. So decent chance, probably better more often than not, that their investment will return them money and the state money. So we're talking about holes in budget. You said 25 million. Honestly, sounds like a small number compared to the entire budget, with no acknowledgement whatsoever of the increase in tax revenue that this could bring. So I think that that's an important thing, and I hope you would agree that we ought to consider the benefits of allowing folks to invest more freely in small businesses to the maximum extent possible. You said the limits weren't enough. I think they're too restrictive. But I think that an acknowledgement of the increase in the tax revenue base is important on this topic.
No, thank you for that, Representative. And I mean, I do want to be clear. I mean, we do see the merits in some form of community investment and increasing, potential investment opportunities there, especially for the non-accredited investors that, the previous individual spoke about. But, as always, we believe that would need to be part of a larger budget conversation, right? And we would also want to include the MEDC at the table on that, and potentially maybe some other departments as well to, make sure that we're targeting these investments in a way that, would benefit the state with the amount of capital that we have available.
Mr. Chair, if I could, I think you're right. Larger budget discussion, I'm sold on that. But I think the budget discussion would be what we're going to spend all this new money on, because we will make revenue. This is an investment. And the sheet we were given on the Nova Scotia example says it cost the government $583 dollars to create a job. That's not even true because we increased tax revenue. Revenue to the state, according to this study, which we can look into, was $25 million. So they lost $700,000 of tax revenue and made $25 million of tax revenue. So that's a good thing. We could sit down and have a conversation about what we want to spend that extra money on.
I was happy to have a conversation.
Thank you, Mr. Chair.
How would you mentioned a few times in the testimony, Aaron, that you think it should be more targeted. Do you have any guidance there in terms of what are we trying to target here under your view versus these ideas of Michigan businesses with 80%, assets and 80% their business in the state and all that? What are we trying to target here? Can you expand on that?
I don't know if there's anything that we're trying to target necessarily from Treasury's perspective.
But what would be an example? I mean, when you're saying target it more, the target right now of this seems to be Michigan businesses that are making Michigan transactions that have Michigan employees and assets. So that's pretty targeted, right? Because we all agree we don't want this money, this tax credit going to tech companies that are operating in California. When you say it needs to be more targeted, how so?
Whether it's targeted just for startup businesses or businesses that have been around for a while, if we're targeting specific industries that we maybe want to grow or expand in Michigan. I mean, I think that those are all policy questions that I think are worthy of a discussion. And then, there was a previous credit on the books a number of years ago, and I know that credit had a number of caps on it as well. I got a list of some of them, in terms of saying the MSF shall not certify more than $1 million in qualified investments. The taxpayer cannot claim a credit of more than $250,000 in 1 year. Qualified businesses meant that it has a pre-investment valuation of less than $10 million and fewer than 100 full-time employees. So I think those are all examples of how it could be further targeted to maybe get more return on the investment.
And you're referencing a prior bill or law?
A prior MCL, yes.
Which one is that?
It's 206, 278.
206. So what is that credit?
It's a credit that was in place for a very short period of time. It was enacted for investments after 2010, but the investments had to be made before 2012. Mm-hmm. It was sunset as part of the tax reform in 2011.
Okay. Yeah, we'll take a look at that then. Derek, you got that? What'd you say it was?
PA 235.
I don't think it's 235. It's a different one. Which one is it?
No, it's MCL 206.278.
206.2. All right, cool. Well, we'll take a look at that. All right, and I appreciate that answer. We'll go now to Representative Brixey.
Thank you, Mr. Chair. Mr. Kahle, I'm wondering if you could elaborate on when you said that there isn't evidence that angel investment promotes entrepreneurial activity, I think you said. And I'm wondering if you could elaborate on what we do know that does promote entrepreneurial activity, because I know this isn't Nova Scotia. That's one thing I know. So.
Absolutely. Mr. Darrow, do you have any insight on
Yeah,
that?
just one of the things that pop up are research and development credits generally tend to promote entrepreneurial activity on a larger scale. A credit like this
here in the States.
Yeah. Yes.
Okay. And, the economic differences, I think the kind of fundamental differences between Canada and here in terms of businesses and business investment is that you have health care that is taken care of at the national level. And in the U.S., our economic system requires healthcare costs. And there's some pretty big differences in terms of what kind of expenses businesses have in the two countries. So I'm more interested in U.S. examples of entrepreneurial investment, and I think there's an old saying, a bird in the hand is worth two in the bush. And so, the idea that because we have a piece of paper that says this Nova Scotia fund generated, what did it generate, 25 million or, the idea that that is going to exactly happen here in Michigan, I think is really not a valid comparison. So I would want to see some more information, but I do want us to promote entrepreneurial efforts here in Michigan, and I also want to help businesses. I mean, we've got money right now, COVID relief money, that we're holding up, that we're not spending on our businesses, our small businesses that are needing funds right now. So that's something concrete that we can do today that we're not doing, that I think we really should get a move on. Thanks.
Thank you, Representative. We'll go now to Representative Farrington.
Thank you, Mr. Chair. I didn't see anywhere in the bill. Are these tax credits transferable?
I don't believe they are.
Don't believe they are.
We'll go now to Representative O'Malley.
Thank you very much. Can I ask the sponsor a question?
You don't have any further questions for Treasury?
Well, it may be.
Okay. Do you want to come up, Rep. Kahle? And do you need Chris too?
My question, you can decide. My question is, they talk about research and development being big, folks, and my colleagues worried. As I hear this, talking about our small towns, this could be the flower shop that wants to open up, or this could be another store. It doesn't have to just be business and tech, right? This could be Main Street that I could invest in. Is that correct?
I don't know. Maybe you want to sit up here at one of these. Okay, that's fine. I want to keep everybody social distance.
Thank you. Thank you for your question, Rep. O'Malley, and absolutely. In fact, due to the SEC limitations on non-accredited investors, it's not likely that, let's say, the max you could do in a year is $2,000, that you're going to invest. It lends itself naturally to a small business in your community because of those natural limitations.
Yeah. I guess so. That's when I hear this, it's like we think big investment, but this is actually to think small investment. This is about my Main Street. It's not about, well, I'll go to the old, not Wall Street, it's Main Street. So that's why I think this is a great thing to help our local communities and help our local folks invest in our local community. So I just kind of wanted to make that clarification because it sounded like we're worried about the big business, and God bless them, but your bill is more towards the small guy.
It truly, truly is. And Rep. Brixey hit it as well. And we think about last year in particular, it's more timely than ever. Began working on this pre-COVID, but it's now truly more timely because who suffered the most? Was it Meijer? Was it Lowe's? Was it the big guys? Not really. It was the small little businesses that weren't able to operate as well. And they're what make our communities what they are. They are truly the backbone of our economies here in Michigan. Thanks.
All right. Was there any question there for Treasury? Okay. Thank you, Rep. O'Malley. We don't have any further questions, so thank you, both of you, for being here. And I give Derek credit here. Derek kept saying PA 235, which is the same thing as this MCL. So that was good. You're right again, Derek. So we'll take a look at that and see what type of limitations might be in there that we could consider. So thank you for that, members of Treasury.